example of that, and the most recent one was Greece. Oh my God, they got $450 billion of debt. This economy of 11 million people can't pay it off. So fine, we'll get someone to write off $100 billion, which they did. And the new debt is trading at something like 20 cents on the dollar. So, there's another default. The bond market's already saying they're not going to pay off the existing debt that they just issued. So that's where your productive capacity can't deal with the debt. I think Japan's in that situation. I think lots of European countries are in that situation. I think the U.S. is in that situation, that with all these obligations, the known direct ones and then the unknown indirect ones, Social Security payments that haven't been funded, pensions to civil servants, military commitments, Medicare that have not been funded, and these things are out of control. And I think the recent numbers are the real liabilities on a net present value basis are about $80 trillion. And you can imagine a $15 trillion commodity trying to pay off $80 trillion of obligations. I mean, it's impossible.
So we're writing off Western Europe and the U.S. What about Asia? What about China?
Well, unfortunately, the data in China is deteriorating. And I think the most instructive number to look at is the China Purchasing Manufacturers Index that HSBC puts out once a month. And it has been in contractionary mode for 5 years. It says that the manufacturing in China is negative year over year. And a lot of people would probably find that hard to believe, but that's what the survey says. And the last month out, it fell from something like 49.5 to something like 47.5, which is a bigger decline than one expected. We had a report that Chinese companies' earnings are down 5.8% in the first 2 months of this year. So I happen to be in the camp that thinks that China also overexpanded, overlent, and might have their own Minsky moment, although certainly not to the extent of the more developed countries.
Certainly, you've given this a great deal of thought. How are you feeling about the next 5 or 10 years? How are we going to remake ourselves as a global economy?
Well, it's interesting. I think it's just much easier to discuss 5 and 10 years than it is, for example, the next quarter or the next half or something, because there's lots of influences that kind of rule the day over the short term. For example, we have this supposed big jobs recovery, which I very much question, and the stock market's going up because everything is getting better, although, as David Rosenberg explained, for every economic indicator going up, there's 2 going down. You could talk about housing, you could talk about durable goods, you can talk about consumer sentiment. There's all sorts of things that aren't good that are going on. FedEx warned. I think we're likely to get other warnings here, particularly you have to have a customer who's buying your goods, and if your customers are Chinese and European, I don't think, and UK, for example, they're not doing well, and if you don't have strong customers, it's hard to keep things together. Not that I'm a believer that we have a strong economy anyway. I don't believe that here in North America. But when you look out 5 or 10 years and you see this mountain of debt and the disparity between the workers and the non-workers, as we have 10,000 people every day retire, and those people probably are reasonably well off and at reasonable wages. But the guy coming in is getting shortchanged these days. I mean, when I sort of contrast what it was like when I started working, you could imagine getting a 10% wage increase for a number of years in a row. I don't think that condition exists today, and people coming out of university are all saddled with big loans going in. I don't know how one could honestly imagine that things will be the same in 5 to 10 years as they are today. I can't imagine it's better.
One of the people that's benefiting from all of this is Eric Sprott. You are selling gold and silver.
Well, we're benefiting from the point of view that, yes, people want to own gold and silver. As a firm, we're not benefiting from the point of view that gold stocks are not doing well. We tend to have a bearish stance in the market. Of course, the market's worked against us here for a number of months. So, yes, we have some wins, but we also have some losses. I think given the passage of time and the facing of reality by the market, both theories that gold will go up and that the stocks will have a correction here will play out.
There are few companies that seem to be extremely resistant in this market. Not many, but there are some. You think there's a rally going on right now with some steady growth?
Well, there's definitely a rally going on. We know that. To what degree we have growth is open to question. I'm going to quote from a report that I read that suggested, I'm not really sure of the timeline, but let's just say they said, well, from 2007 to today, sales of companies are up by something like 5.8% and profits are up 95%. Well, that's not something that will continue. That's a mathematical certainty. You have to have more sales. You can't have your sales going down and expect your profits to go up. And we could pick any number of industries, whether it's the housing industry, whose sales are probably down 75% from their peak, or the auto industry, where the sales are down 33% from their peak. It's very difficult to think that we're in some great, strong economy. We're not. We're just bumping along in the bottom, and of course there's a lot of hope that it gets better, and every now and then we get some data, such as the jobs data, which again I question, that says it's better. But, as Chairman Bernanke said a couple of days ago, we've had some good data, but we always got to be vigilant because it may not continue, and we got to remain accommodative. And I suspect that we've had a very benign time here in January and February because we haven't had the seasonal impact we normally would have. And I suspect that those seasonal adjustments made the jobs look better than they are. And once we get back to apples comparisons, I don't think it's going to look that good. I suspect that's true in the home front, too. I mean, it was a great time to go out and look for homes in January and February this year when you wouldn't even thought of it last year. So we may have pulled some of our economic strength into January and February, and once we get more normal apples-to-apples comparison, we'll find out that the first 2 months borrowed from the subsequent months.
Do you think that we're primed for another event like we had in January of 2008? And if so, would that be a fatal blow?
You're referring to the market correction, is that?
Yes, around January 17th, 2008.
Yeah, well, that could happen at any time. I mean, I sort of sit back and I'm amazed that the market's done what it's done, and I tend to be a non-believer in the market. I always find it shocking if the market goes up on continually declining volume, which is not what's supposed to happen. If people are bullish, you're supposed to be investing more in stocks. You should be higher volume, but somehow we're in this miraculous situation where the volume almost goes to record lows, and yet the market keeps rising, and I can imagine that things could fall apart rather quickly. That's exactly what our thesis is, that the economic data is not going to hold up, and all of a sudden we have this paradigm shift where, oh my God, we thought it was getting better, and it's not. And I suspect that Bernanke was kind of leaning that way, that he's waiting for some of this data not to confirm. He said, well, yeah, don't worry, we'll be ready with QE3.
What positive message can we finish up this conversation with, Eric?
Well, I think that when I look back at the trading history of both gold and silver, you see very unusual events that have happened. As you may be aware, there's a lawsuit against JP Morgan and the HSBC that they manipulated the price of silver in 2008. That is a public document I'm referring to. There's been a 3.5-year investigation by the COMEX about whether there's been any manipulation in the silver market without any answer, which is kind of mind-boggling that it could go on that long. There's very strange things happen in the paper markets from time to time that those of us who are students of it just can hardly believe that certain things happen when they do. The most recent one was Feb 29th, when all of a sudden at 10 a.m., just as gold and silver were breaking out, all of a sudden they had these massive reversals. For what reason, I'm not sure. Gold went down $100 intraday, which is, you'll never see it go up $100 in a day, by the way. Or I shouldn't say never, it probably will, but it doesn't normally move much more than 1 or 2% in a day. So I just think that sooner or later, the physical markets are going to overwhelm the paper markets, and we'll hopefully get back to sustained increases in prices yet again. I mean, gold's been the investment of the last decade. It's gone up every year for 12 years. Silver's been a little choppier, but it's actually gone up more than gold on a percentage basis. And I'm pretty optimistic that when we get to the end of the year, we'll be at new highs in gold, we'll be at new highs in silver, and the stocks will react accordingly.
So the market will withstand and overcome, if not overwhelm, this forced suppression by perhaps the banks and the Fed combined. That can happen more than once, can it? Well,
I think one of my peer group, James Turk, put it best. He said, Eric, there's a managed retreat. There's just a managed retreat in the price of gold. It never goes up that much in a year, I don't even know if it's ever gone up 20% in a year, but it's averaged something like 17, and never without volatility. There's always this volatility, everyone hates it for 3 months, and then it works its way back up, and then they hate it again for 3 months. Given time and given what's going on in the world, the debasement of currencies, it's hard for me to imagine that rational thinking people don't realize that owning gold and silver is a way better bet than, for example, owning a bond. I mean, I just can't believe that people would own bonds when you look at the balance sheets of the countries of the bonds they own. I mean, they're an absolute mess. As I mentioned to you earlier, just imagine if you're a consumer, and I'm going to say instead of the $15 trillion the U.S. government has, let's say somebody had $15,000 of income and they're trying to support $80,000 in debt. I mean, there's just no way that it's possible to do it. The math just doesn't work. So therefore, they got to keep trying to find some way of extending and pretending and suggesting everything's wonderful and good. And that will, of course, lead to more and more concern about the currencies, which will obviously cause people to go to gold and silver, which it's done for the last 12 12 years.
Well, Eric, it's been a great pleasure speaking with you today. It's been enlightening. I look forward to visiting with you again in the near future. Thanks for your time.
Ellis, it was all my pleasure. All the best to you.
I've been speaking with Eric Sprott, the chairman of Sprott Money, owned the only real monetary assets, physical gold and silver bullion. Hear this segment again on the podcast page of our website, ellismartinreport.com.